Hi, Wes. Hi, Katie. It's great to be with you today. Cadwalader is very active in the fund finance space. You get to see a lot of what's going on from the front row. Tell us, how has momentum around ESG and distinctly green-focused investing, how's it been impacting fund finance in recent months?
Thanks for having us, Bill. We appreciate it. ESG is certainly a hot topic these days, and so it's good to have these discussions. I will say, things have really picked up. I mean, ESG has been in the works for a while, but last year you kind of look at investment activity and you had over $50 billion that were raised for specific ESG focused funds in the market. And these are funds that are 100% focused on ESG type investments. And you take a look at kind of the landscape too, and fund managers are really responding to this on the whole, and not just for ESG focused funds, but for other funds that may, have an asset class that doesn't exactly align, but there's the ability to do the E, the S, or the G in some fashion. And so you kind of look at some of the surveys that have been done. I know Preqin, according to surveys they've done recently, 69% of fund managers have either already established an ESG policy or are currently working on doing so. So that's over 2/3 of the market right there. And when you ask investors, why is ESG investing so important and what are the benefits of this, it's a pretty lengthy answer, but 89% of investors view this as being positive, not only because of the impact you're having on these broader societal goals, but because they view it as having a positive impact on returns. And so I think that's incredibly powerful. And just given the volume and the amount of capital that we're talking about and the interest in this space, it's naturally flown into our space and fund finance, and we're seeing a huge uptick in this. And so, I will say, Bill, that it started off in Europe. Europe is, a little bit ahead of us, probably maybe even close to a year ahead of us in terms of transaction volume in the space. But I started doing my first call with banks last summer, saying, hey, we're getting some interest from our clients on doing ESG facilities. How do we do this? And so we all kind of had to get smart on it and figure out what was going on in the market. And we talked to our European colleagues and we saw what was going on over there. And it's pretty interesting. And ever since those initial conversations, boom, we had a term sheet come in the fall. We were working on our first facility. We closed it in January. We've now done 6 of these deals overall. And we're currently working on 4 more. And so it's very exciting. Each situation is unique. That's what I love about doing this. So, my bread and butter is doing subscription finance, and I've been doing that for 15 years. But it's nice to do something that's a little bit of a different flavor, and certainly something that's going to have, the impact that ESG is having, on our global market as a whole.
Yes, definitely. And after all, companies today are increasingly devising sustainable, diversity, and green strategies, which inevitably form part of the financing criteria. And some of the main benefits of ESG facilities include, they provide accountability for the fund in question. For example, if the fund doesn't meet the ESG target or the KPI, it might not avail of the discount in the loan pricing. ESG loans also provide greater transparency to investors in that it's easier to track or measure the performance of the fund and achieving the ESG goal. And both the lender and the fund can also benefit by building stronger value-based relationships with investors who also value ESG investing. And ESG facilities may also have a positive reputational impact for both lenders and funds as advocates of the ESG goals.
Thanks, Katie. Thanks, Wes.
Yeah, Bill, tell us a little bit about what KBRA has been up to and kind of how your diligence, how that's changed over the last few months, given this focus on ESG.
Boy, that is a big question. It's changed quite a bit. And I'll talk a little bit about KBRA across all of the sectors and then focus a bit more on how ESG factors are impacting diligence in funds specifically. We've got now about 150 funds related transaction ratings, which is quite a lot of growth. And a lot of the funds and the GPs that are managing those funds have ESG strategies. So let me jump in to the diligence approach, which is different than other rating agencies. So I think it's important to underscore that. So first, we do not use ESG scores in any of our 40,000 plus ratings across KBRA. We think that credit analysts should focus on the ESG topics that are material to credit. And this includes analysis of how management teams manage ESG risks and opportunities. And we call this approach ESG risk management analysis. And we think this is a much better approach than having credit analysts wading into what you guys know is a very subjective process of deciding which S or G topics are more important than another, and then how to weight them or rate them. And we think those subjective choices are the role and responsibility of investors. And we think that's a very important role and responsibility. We just don't believe credit analysts should be focused there. Having said that, we do distinguish three ways that ESG issues can impact fund transactions and align our diligence accordingly. First, with regard to the things that you were just talking about, and at the most basic level from our perspective, as it relates to sustainability linked notes, across all of KBRA, we examine how the failure to achieve the targets embedded in the notes or the triggers that might be embedded in the notes, we look to see whether or not they can impact the ability to meet debt service requirements. Truth be told, most of the penalties or rewards with these sustainability linked notes that we've seen to date are relatively immaterial to credit fundamentals, even if they are very material to investor interest and responsiveness. But nevertheless, we diligence whether or not these triggers can introduce a new layer of credit risk, and we'll introduce new stress tests to that effect. Second, as it relates to pre-existing funds and their pre-existing assets, our due diligence has expanded to include questions regarding how certain risks like climate, carbon transition, cyber risk, and something we call stakeholder preferences might be impacting those assets. So at the asset level in this last category, we recognize that stakeholders at the asset level, customers, employees, regulators, lenders, they may be shifting their preferences or demanding changes in how those companies at the asset level are being managed or what they do. And in all of this second bucket of ESG diligence regarding the assets, we want to know how the GP is identifying and responding to these issues and how these may impact margins and valuations at the asset level. And then third, at the GP level themselves, we all know that many LP investors have intensified their focus on ESG and have begun gating their investment allocations against some of those preferences. So this requires changes to how GPs manage their own operations, their own governance, their own diligence, their own choices regarding assets, even if it's not an impact fund. We understand that these investor preferences are impacting everything they do, how they manage and how they select assets. So not addressing these topics in a transparent way can impact the ability of GPs to raise money in future funds, which in turn can impact all sorts of rated debt transactions that may in part be dependent on future fundraisers, as often GP balance sheet transactions are. So it's a really complicated series of questions that hits each layer of the private market due diligence. And speaking of which, I'd love to hear more about what you all are seeing with regard to those performance indicators, because like I said, we've seen them be pretty benign so far with regard to credit across our landscape of transactions. But what are some of the most common ESG performance indicators that you've seen loans linked to in your practice so far?
Yeah, Bill, it's really interesting because, as I said, in the US, we're certainly still early stages on the development, so it's a small sample size. But I can tell you that the nice thing about ESG, and particularly when you're trying to put together targets and then KPIs to measure against that, is the flexibility you have. And you touched on this a little bit in talking about the diligence and the credit analysis. You can structure the KPIs at the fund level. You can go upstairs to the GP and the management company level, and you can go downstairs to the portfolio company or investment level. And so I think kind of early on, what we're seeing already with a lot of private equity funds that are more traditional buyout style funds is they're structuring it down at the portfolio company level and really measuring impact based on board diversity of portfolio companies that they acquire and that they already own over a period of time. And that can be based on gender diversity, racial diversity, what have you, and obviously aligns with broader societal goals and a broader movement that we're seeing go on in the U.S. today. And so that's one of the most common ways that we're seeing KPIs structured in facilities now. And it can really apply to any type of fund. So like I said, in this instance, we're talking about a pure play private equity fund that is acquiring companies. But it could relate to a climate change fund. It could relate to other funds as well. So there are lots of ways, and there's lots of flexibility in terms of how you can structure the KPIs. In terms of board diversity, you're really hitting on two of the three of the ES and the G, the social and the governance. And so that's powerful. And I do think, oftentimes we're only seeing one of those, but where we can see convergence of two and maybe even three, that's even better. And I think we're going to start seeing a trend go more in that direction as well. And this obviously aligns with the investor view in terms of, investors, 89% of investors say, hey, we're going to get better returns, as good returns, if not better, by making these targets. And when you talk to the fund managers, they're really coming back and saying, look, our research is showing if we have more diverse boards, these companies are actually performing better as well. And so I think you see a whole alignment in terms of what the managers are seeing by executing on these and in terms of what the investor outlook is.
Yeah, so adding to that, there's a lot of flexibility in setting the KPIs. And generally, they just have to sync with the fund's overall ESG strategy in accomplishing the E, the S, or the G. And KPIs should be ambitious and meaningful to the borrower's business or bespoke, but also achievable within a certain time frame, according to the facility. They can be measured monthly, quarterly, semi-annually, or annually, and yield the negotiated trigger outcomes. So there's wide latitude in establishing specific KPIs, but care should be given to ensure that the goals are suitable and aimed at real change to advance the investment. As Wes mentioned, KPIs can be measured at fund level, management level, or portfolio company or investment level. For longer facilities, those tenors may also be ripe for adjustments to KPIs or the ability of the parties to revisit the targets or request changes upon the occurrence of material events or set time periods. Another option for the parties is to avoid specific KPIs altogether, but require a third-party sustainability ratings firm to provide a score for the borrower. The score can then be used to trigger the same outcomes as the KPIs. We understand that KBRA, as you mentioned, doesn't support the score approach to review and instead undertakes a difficult credit analysis. And Bill, I know you touched on that earlier, but perhaps you'd like to comment on that.
Yeah, we've seen obviously a lot of focus by investors on ESG scores because they need something to anchor their allocation to and build some kind of internal consistency. But what we've heard from investors over and over again, and we conducted dozens and dozens of interviews over the past 18 months, is they'd prefer to develop those scores internally and or work with parties that are focused on ESG scoring that they align their preferences to. And with regard to what they want from rating agencies, and us in particular, is for us to focus on the ESG factors that present risk to the transaction. And that's what we do and we remain committed to. And we've seen increasing numbers of funds, as Wes outlined in the beginning, that have highlighted how they are going to select assets that have a positive impact, and they're going to measure that impact in a variety of ways. And in the recent past, many funds were defined in a separate category called impact, and they still are. And it's still popular. But what we're seeing now, which is really fascinating, is that most investors, regardless of the category, regardless of whether or not a fund is or is not called impact, are demanding transparency regarding the ways that any fund manager, any fund, and any asset in that fund are having impact on the world. And at the end of the day, regardless of correlation to those realities and the performance of the fund, investors want to see both. They want to see some sort of focus on responsibility at the GP, at the fund, and at the asset level, as well as performance. And they're generally not willing to get smaller returns for having responsibility. It's a really interesting evolution that I wouldn't have said what I just said 18 months ago. In a recent podcast I did with Dan Daniello from Carlisle, he called this new reality stakeholder capitalism. And I think that those two words really sum it up really well. I thought that was a really great way to describe what we're all seeing. And I guess in that regard, given the appetite, the absolute hunger for ESG and climate-linked and impact-linked transactions, are you worried about whether or not there is so-called greenwashing in the market? Are there too many easy ways to get labels for funds or for transactions? And how can you guard against this?
Yeah, Bill, it's definitely a concern that's crept into the market, and rightfully so. The possibility of managers trying to exaggerate claims on the effect that the investing is having and putting a label on there. Really the question you've got to ask yourself is, would we have had the same results whether or not we're calling this a green facility or a sustainability facility? And if the answer to that is yes, then it's not really a sustainability facility, right? Because we're supposed to have meaningful and ambitious targets that are aimed towards achieving those goals. And so I think we've got to be careful of greenwashing, and we've got to be careful of just simply putting labels on things. In terms of direction the market is heading to try to deal with this issue, one thing that came out of, so the AP LMA, the LMA, and the LSCA collectively have been the publishers of the sustainability linked loan principles for a couple of years now, and they just came out with a revised version in May of this year, the May 2021 version. And one of the interesting changes in that in the guidelines is that now for a true sustainability linked facility, you need to have third party independent verification on whether or not the borrower is meeting the KPIs. And so previously this was not required, it was recommended, but now it is a requirement. And so you've got to have a third party auditor, consultant, rating agency come in who's qualified, who needs to take a look at the borrower's performance against the KPIs and report back on that. And then the lender is supposed to take that information in terms of deciding whether or not the borrower is actually meeting the targets. It is interesting to note, though, that a lot of facilities, particularly green loans, where you've got a more use of proceeds style facility and it's not linked to performance indicators like KPIs, the third party verification process is not a requirement. It's recommended, but not completely required. And so there are still other ways that facilities can be done that do not require third-party verification. But certainly, I think it's easier to have reporting and confirm use of proceeds versus whether or not you're meeting various KPIs. Those can be more complex. Those sometimes I think could lead to a situation where you've got somebody greenwashing or sustainability washing. And so, it's one way the market's tried to combat this.
Yeah, and just to add to that as well, obviously reputational risk considerations could come into play if material events occur that question the quality or the veracity of the achievements. But greenwashing also potentially causes a serious undermining of this product. The parties might look to employ protective clauses, as Wes mentioned, that would unwind the ESG nature of the transaction if a material likelihood of washing behavior exists or a triggering event happens that could cause substantial likelihood of embarrassment for the parties. These clauses, however, are often difficult to negotiate, and so the concerns are commonly mitigated by other factors such as sponsor selection, track record, audit rights, and third-party verification. Events of default may also be included to deter against greenwashing. However, it should be noted that on the one hand, having an event of default can help to deter bad behavior such as sustainability washing. However, an event of default could also have the effect of reducing meaningful impact by making the borrower reluctant to agree to take on an ambitious sustainability target. So another way to address this is via pricing increase. So you would have both a ratchet up when it hits the KPI and then a ratchet down when it doesn't.
Thanks, Katie. Bill, I want to ask you a little bit about, how can the ESG factors specifically affect asset quality in the analysis that y'all are doing on funds?
Great question, Wes. In all the ways I described when talking about the note analysis a few minutes ago, and then some. So it can be very idiosyncratic to the assets industry or sector. Obviously, if assets are in the energy space, our level of diligence and questioning can be quite extensive, even if it's in renewable. Because sometimes renewable companies might be very dependent on subsidies. So there are all sorts of questions in that space. So, but I think broadly speaking, climate and carbon transition is a common theme. It's hard to imagine an industry or sector, now even banks, where our questions aren't necessary to understand what banks are doing, for example, to prepare for what might be regulation regarding disclosure of their funded emissions. So carbon and climate transition risks are front and center. Cybersecurity is something that is a very common theme at the asset level. And then this concept of stakeholder preference and stakeholder and reputational risks. These can be impactful to any organization. It could be selling widgets in the Southwest US, but it could do something wrong. It could have the wrong composition of board. An example of these kinds of idiosyncratic risks are throughout any industry. Anyone is exposed if they're not managing to the responsiveness and transparency that stakeholders are demanding. And that leads me to a question for you guys. I mean, you've done a very interesting transaction recently with Bank of America, speaking of banks, on a $4.1 billion ESG-linked credit facility tied to, I believe it was board diversity goals. Are you allowed to talk more about the structure of the transaction? I think listeners would love to hear more about it and what happens in that transaction if the goals are not met.
Yeah, Bill, it's a very interesting transaction for sure. One that was a market leader in our space, the largest one ever done, not only in the US, but globally that we're aware of. Really kind of crossing the S and the G in terms of targets based on board diversity of portfolio companies. We can speak a little bit about it, but unfortunately not at liberty to disclose a lot of the details, given that it's not a public deal, but there is publicly available information. Carlyle put out a press release, and certainly there's been a lot of attention that the facility received in the market. You're correct that the ESG components were performance linked to KPIs. The KPIs were around board diversity goals that had to be achieved within a certain timeline. If these goals were met within that specified timeline, then Carlyle was able to avail itself of a discount in the loan pricing. Carlyle structured this facility for its America's corporate private equity funds. So not just one fund in particular, but really an umbrella of various funds. And so this was really impactful. And obviously, given the size, $4.1 billion on the facility kind of gives you an idea. The price of the debt was directly tied, as we've said, to the KPIs on board diversity. And really the overall target here was having 30% or better diverse directors on the boards of these Carlyle controlled companies within 2 years of ownership. So this was a groundbreaking transaction, not only for our market, but I think for ESG finance overall. And certainly, it's exciting. And I know Carlyle, this is very important to them. It's very important to Bank of America, who led this facility, and to a lot of other players in our space. And so hopefully there's going to be more of this to come.
And Bill, what ESG factors are most likely to affect the creditworthiness of a fund and the risk of default?
Yeah, Katie, they're similar in some ways to the assets, but there are subtle differences and perhaps different risks. And let me address it at three levels. First, that, as I mentioned previously, the GP itself needs to be transparent and responsive to its investors and their preferences, in addition to performance, in order to continue to raise new funds. So we have transactions that are tied to management fees. And therefore, and sometimes it's not just currently contracted management fees, but it's also future management fees against future funds. So we are obviously, very diligent in understanding how the GP itself is managing its own reputation and its own positioning vis-a-vis investor preferences. And then second, at the asset level for a fund transaction, we think that, again, there are idiosyncratic risks that go beyond, the broad general categories of ESG-related risks and opportunities. But for most assets, the medium-term risk related to, for example, climate boils down to regulation. And carbon transition risk is something that almost every company in every sector should be analyzing. And in addition, again, at this level, to stakeholder preferences. And that transaction that Wes just described is really interesting because you've got the GP committing to make changes at the asset level. And that's the kind of alignment that we think is going to be increasingly inevitable because of investor demands for it to be the case. But in any event, GPs are likely needing to help with those goals, those targets, even if they're not linked to notes. That analysis of what are as an asset of a fund, what are my risks on the landscape of ESG issues, and the GP is often going to need to help lead the identification of ways that any of those risks, whether it be carbon regulation, board diversity, stakeholder preferences, how those may impact margins and ultimately valuations. And obviously the valuations of the assets is so critically important to the rating itself. And other risks I mentioned previously are important at every level. Cyber risk is important at the GP level, at the fund level, at the asset level. And we just see this as being not just headlines every day, but in our due diligence of companies that we rate, of assets that we're diligencing inside of funds. This is such top of mind issue right now, and whether it be insurance against it, the various technological barriers and protections and staffing protections that are increasingly prominent, all of those things we're seeing greater and greater investment in and attention to, and we think that's prudent. And in any event, future fundraising can be impaired by any of these things going in the wrong direction, and that obviously is very important to most of our ratings. And Wes, I don't know if you have any other thoughts. I think we've covered quite a lot of territory here. And Katie, do you have any other questions for me, or should we?
Yeah, I would just say, all of this comes down to quality over quantity, right? So I think there is sometimes folks, get wrapped up in the KPIs and get wrapped up in trying to set lots of different goals and try to be overly ambitious at times. I think it's good that in terms of how we structure these facilities, particularly in fund finance, usually it's not going to be an event of default if you fail to meet a KPI or satisfy the goal. And the reason for that is we want to be able to incentivize behavior and have the borrower set something that is going to be real and be meaningful and achieve that quality, and know that if they know it's going to be an event of default, if they fail to do it, then they're less likely to want to do it, right? And so there are ways that you can even have pricing increases. You can have other things there that could be a hammer for failing to do it. But at the end of the day, it's about a partnership. It's about the parties coming together to achieve the meaningful change, and that's pretty special.
Yeah, that sounds spot on, Wes. And we have a phrase that we use when we're looking at transactions where we want to see alignment of interest between investors and the funds and the GPs. And it sounds like what you're describing is exactly a way to create alignment of interest around impact without blowing up a transaction as everyone grows and learns on these important topics. Really interesting. I learned a lot today and look forward to more conversations.
We learned a lot as well, and certainly about the rating agency process and the great things that KBRA has been doing. So thank you.
Thank you, Wes. Thank you, Katie.
Thank you, Bill.